and see if we can apply the same information. So I'll start off by giving you format for income statement. So usually we'll have the name of the business, for instance, to the top. Amani Limited. For this one, it was extracted from Amani Limited. So we'll have Amani Limited. Amani Limited. We'll write in full. Income statement. Income statement. Then as at, either as at or for the year ended. As at, let's confirm the date. It was December 31st, December 2016. As at 31st December 2016. So after putting in the dates, draw that, then you'll have here a column for shillings. We'll also have here another column for shillings. So the first item to record on the income statement, we usually record sales. Sales. So we'll record sales, and sales, the value we'll record here. When we sell goods, at times those goods are returned to us. How do you refer to that?
Return inward.
Yes. In that case, we'll do less return inward. Less return inward. So we'll record here. And it will be in brackets. So when we subtract that, the figure we get here, the figure we get here, we refer to it as net sales. We refer to it as net sales. That means the amount of money we made sales, we less the things that we sold and were returned back to us. So to get net sales. Then we look at cost of sales. Cost of sales. Some books refer to this as cost of goods sold. So underline. So for your sake, for the purpose of revision, you can write stroke cost of goods sold, cost of sales, or cost of goods sold. Now with the cost of sales, our first item to record is usually opening stock. Opening stock. Then we'll record on the center column. Then after opening stock, the next item, we add purchases, the other items that we could have added to the business. Add purchases. So purchases, we record them here. Then after we have added purchases, in case we transport goods, if we buy goods and we transport them on our own. For example, if you are in Nairobi and we want to deal with to sell plastics, we'll go to Kamkunji, or household items, we'll go to Kamkunji. So when we buy items from Kamkunji and we have to get a cart, mkokoteni to take us to stage, then we have to pay matatu to take us to wherever estate we want to sell those items. So the cost we incur to transport those goods, we refer to them as carriage inward. Sorry. We refer to it as carriage inward. So we record here, we add carriage inward. Carriage inward. So we add to the cost of purchase. The reason why we add to the cost of purchase, that there are high chances that the person or the shop that you are going to buy those goods at Kamkunji, he also could be supplying those goods. That if at all he come to supply those goods to our and in our premise, the charges that he will charge will be slightly higher than if we went to Kamkunji directly. That if we went to the factory, we'll pay lower cost because they are not incurring any cost to transport those goods. But now if they transport to us, they will likely to pay higher cost. So the cost we will pay if we have bought from the factory, we still have to add to the purchase price so that we get how much then we have purchased. And then from there, we less return outward. Less return outward. Return outward, these are the goods that we could have bought and we have returned it back to the supplier. Maybe just to recap, who can tell us some of the reasons that we can return goods to the supplier, or our customer can return goods to us? What are some of the reasons? Georgina? Okay, Rachel, you are on. Rachel, go ahead.
When they're not in good condition, maybe they're damaged or something like that.
Yes, if they are damaged. Imagine if you are getting bread, then bread comes when it has been squeezed. So we can't sell that particular bread. So we return back to the bakery, the supplier. Kennedy? No, Georgina, you had a point.
I think it has been said. I wanted to say if they don't meet the standards of the customer.
Yes. Now, if getting spoiled and not meeting standards, those are 2 points. Don't mix up. So now, if they don't meet the standard, for example, if at all you make order to buy some shoe online, and once you have been supplied with those shoes, you realize they are either too big or too small. So in that case, they don't meet the standard. They could not have been spoiled, but now they don't. You cannot fit in. So in that case, you'll also return back to the supplier. Naomi, any reason why we might return goods to supplier or customers can return goods to us?
If someone bought a wrong item or a wrong item was delivered to them. Yes,
very well. If at all there's a wrong item that was delivered. So for instance, if I made order from BIC, I wanted a whiteboard marker pen. Then they supplied me with the permanent marker pen. So there's no way I'm going to use those marker pens. So I'll have to return to the supplier so that they give me appropriate item. So we know the reason why goods can be returned. So now once we subtract return outward, then the value we get here, we refer to it as a cost of goods available for sale. Cost of goods available for sale. Those are the value of goods that we have placed on a shelf ready for sale, waiting for customers. But now, for some reasons, we may not sell all of those goods. Some of them will remain in our shelf till the following year. So in that case, we'll have less closing stock. Less closing stock. So less closing stock. So we subtract closing stock from cost of goods available for sale. So the value we get here is what we have been looking for. We record it on the last column. That's what we have been looking for, and we have said that's called cost of goods sold or cost of sales. Now, we'll subtract cost of sales. We'll subtract from net sales. So, sorry. So we'll subtract this value from it. Now, once you have done the subtraction, the value we get here is what we are referring as a gross profit. Refer to this as gross profit. Now, once you have gotten gross profit, we'll also add other income. And I'll give you example. All of us have used Kenya Institute of Management for classes. Have you ever seen a business within that particular building that does not belong to Kenya Institute of Management? Hello? For those
No.
who, yeah?
No, I haven't.
You haven't seen?
Okay,
On the
please
ground
repeat the
floor?
question.
I've said at
Yeah.
Kenya Institute of Management, Emperor Plaza branch.
Yes.
Have you ever seen business that is there on that particular building but does not belong to Kenya Institute of Management?
Oh, yes, yes, I have.
Which one?
There's Jumia just next to the entrance of the school.
Yes. Kennedy, another business you have seen on that building?
There is a photocopy shop upstairs.
There's photocopy. Georgina, another business you have seen? Esau, have you ever seen the business that does not belong to Kenya Institute of Management on the same building?
I only remember the photocopy. Okay, within the building, under the Jumia.
Yes, Jumia. Other than Jumia, because it has been mentioned, there are other businesses.
I'm forgetting. There's another. I'm forgetting what they do.
Yeah. Who else remembers any business that you have seen on that building, but that business does not belong to Kim?
I think at the corner, right at the corner, there's a Baker's Inn.
Yeah.
And there's also a certain optical shop.
Yes, there's optical shop, there's Baker's Inn. Have you seen a restaurant? There's a restaurant. There's a M-Pesa shop. And Kennedy, you want to say something?
No. There's a chemist.
A chemist. A chemistry you'll have gone to, yeah. Yes, a chemistry is on another building now. So we have a boutique and all that. Now, in that case, the main business for Kenya Institute of Management, what we'll record in our sales, in our books as sales, is the fee that we'll have collected from students. So that's what we'll record as our sales. But now the other amount of money we'll collect from rent from that, because it's not our main business, so we'll classify it as other income. So we'll classify that as other income. So we underline this because we might have several other income. So we can have rent received. I've given you that in one example, rent received. When you pay money, by the time all of you semester begins and you pay in a lot of money, we usually collect a colossal amount of money that when we save in our bank, the bank pays an interest. So we'll also have interest received. When you buy commodities, because considering the volume that we buy, we also get discounts. So we get discount received. So that's what you'll record under other income. So if we have added those other income, the figure we get still, we refer to it as a gross profit. Then after that, we'll have expenses. Expenses. Each one of you will mention at least one expenses. Whoever is ready can go ahead. Who is mentioning the
Salaries.
salaries and wages? Kennedy?
Transport cost.
Transport, yes. Georgina? Georgina? Esau?
Communication.
Yeah?
Telephone costs. I don't know.
Yeah? Which one?
Communication.
I've not gotten.
Communication. Things to do with
Yes.
telephone.
Communication, telephone expenses, internet. Kennedy, kindly mute. There's an echo coming from your side.
Can you try from your side?
Okay. So we'll have telephone, internet. Those are communication. Who else is giving us? Esau, have you given us cost? Rachel, you are on.
Can we say electricity bills?
Yes, electricity. So those are the expenses that we incur. And in case we have carriage outward is also an expense. That we have a customer who has bought from us goods, then we feel as part of the customer service, we'll transport those goods to his or her premise. So the cost that we incur is still an expense. Then we'll get these expenses, then we record them, and then total we'll bring it here. So after listing all those expenses, the total will bring it here. Then we subtract. We subtract from gross profit. So when we subtract, the figure we get, we refer to it as net profit. Net profit. So would have at that point would have finished income statement. That's how we maintain income statement. Rachel, I can see you are on. Do you have something?
Yes, I have a question.
Yeah.
After we have put the other incomes,
Yeah.
where do we put the summation? Is it on the first or on the second column?
Second.
Or the second column?
Yeah.
Okay.
So
Okay.
now, depending with how many other income we do have, if we only had one, we just record on the last column, then we add to that particular gross profit. But if we had several, let's say we had interest received, discount received, rent received, then we record them on the center column. Our center column is used to do the summation so that we don't get confused. So we'll record, for instance, here. Well, once you have recorded,
then you bring it to the last column.
Then we bring it to the last column and add gross profit to that.
Okay.
Yeah. So we'll add. Then once you have added, the figure we get still we refer to it as gross profit.
Okay.
Yeah. Any other question pertaining income statement? If there's none, I believe that we will assist you in doing that computation if time will not allow us to do the whole computation. Now, so let's look at the second question in statement of financial position. Just to mention something, income statement, some books also refer to it as trading profit and loss account. So if you have been asked to prepare trading profit and loss account, you are being asked to prepare income statement. Other books also refer to it as a statement of comprehensive income. A statement of comprehensive income. So it has those three names, either trading profit and loss account, income statement, or statement of comprehensive income. So if you get in exam, know that you are being asked whatever we have displayed on the screen. Now let's look at the balance sheet. Balance sheet, the other name for balance sheet is statement of financial position. Balance sheet, and I've said it also has a name, statement of financial position. Now, who can remind us balance sheet equation? Because there's an equation that we do use to prepare a balance sheet. Who remembers that equation? Rachel, have you ever interacted with the balance sheet equation?
Yes, I have,
No.
but I don't remember that particular name. Yes.
Naomi, have you interacted with the balance sheet equation?
Assets is equals to capital plus liability. I'm not sure.
Very well. Assets is equal capital plus liability. So in that perspective, when we prepare balance sheet, we want to confirm if at all our business, its asset is equal to capital plus liability. So, of course, we'll start off with the name of the business. This business was being called Amani Limited. Let's share. So we have Amani Limited. Amani Limited. Balance sheet. And I've said the other name for balance sheet is statement of financial position. Balance sheet. As at 31st December 2016. So we want to see how that equation is actually applied in preparation of balance sheet. So the first thing we are concerned, we look at assets. Assets are classified into two. Who can remind us the two classification of assets?
Fixed and current.
Yes, thank you. We have fixed asset and current assets. So we'll start off with the fixed assets. We'll record here fixed assets. Now, fixed assets, they are subject, okay, the definition of a fixed asset, these are assets that are expected to serve business for a long period of time, usually longer than 1 year. For example, if you buy motor vehicle, land and building, plant and machinery, fixtures and furniture, those items you buy are expecting them to serve the business for a very long period of time. So in that case, they are subject to depreciation, that if you bought motor vehicle this year, after 2 years, it will not have the same value. So the value of that motor vehicle will have depreciated. So in that case, when you are preparing the income balance sheet, then we have to create 3 columns. We create the first column, which is costs. Costs. Then the second column will be depreciation. Depreciation. Then the last column will be net book value. Net book value. So for us to do this, we usually prefer to do practically with the information. Now, considering the question we do have, do you have any fixed asset you have identified? Have you identified any fixed asset? Hello, anyone who has seen fixed assets? Rachel? Okay.
I can see the fixed assets, the one that have 1,000, but they're not. I can't see any specified fixed asset.
Okay, we'll deal with the question as it is, but you
Okay.
know those fixed assets. If at all they have not indicated the fixed asset, but they have indicated the motor vehicle, they have indicated land and building, as long as that item we anticipate that it will serve the business for a longer period, more than 1 year, we consider it as a fixed asset. So for this case, we have only been given in general fixed asset, and cost we have been given is 1,000. Have you been given any information about depreciation? Have you seen any information pertaining to depreciation of that fixed asset?
Yes.
What is the information?
Depreciation on fixed assets is 10% per annum on cost.
On cost. So that means as we compute depreciation, we only need 10% of 1,000. How much is that? How much is 10% of 1,000?
100.
100. So you record here 100. That's the depreciation. Now, for us to get the net book value, we subtract depreciation from the cost. So 1,000 minus 100?
900.
900. So that's what will be the net book value. So if we have any other asset, we'll also record in that perspective. Now, there's another fixed asset that I will need to say something about it, because how we treat it sometimes is very different. If we have land and building, so at times you might get that in a question, then you'll find that they had land and building, and it was valued, or the cost was 3 million. Then after reevaluation, now they're telling you the cost or the current net book value of that land is 3.5 million. Now, that's acceptable because land and building, those are two separate assets. We have land, which is an asset on its own. We have building, which is an asset on its own. Now, these two assets, they behave contradictory in this perspective. Building, as year goes, it keeps on depreciating, that it weakens. The iron, the roof becomes dirty, the walls become dirty, sometimes it starts peeling off, so it weakens. So in that case, it's depreciate. But now land keeps on appreciating. So mostly for project or for business, the best method that is recommended to evaluate a value of land or building, or depreciation of land and building, we refer to it as re-evaluation. Re-evaluation. So when you get a valuer to come and re-evaluate our land and building, you'll find that yes, at cost it was 3 million, but now when he evaluates, he finds that the land has increased. Land could have been bought at 2 million. Now it's valued at 2.5 million. Then the building could have been done at 1 million, and it has depreciated by 100,000. So it's at 900,000. So when you combine the two, then you get the value has gone up. Now, in event you have such a scenario, you still record in this perspective. Let's say we have land and building. So if it was 3 million or 3,000, let's say use thousands. and the value has increased by 500,000, so it's now valued at 3.5, you'll still record here that 500,000. Then the value here will be 3.5 million or 3,500. Now, to distinguish so that we don't get mixed up, because the other one we have written 100 and the total net book value are indicating 900,000, then you'll have to distinguish it by putting this in brackets, indicating that it's a negative, it's a depreciation. Then we leave this positive, indicating that it's appreciation. It's appreciation. So you need to distinguish those two parameters. Then once you have done with the fixed asset, we look at current assets. Current assets. Who can mention some of the current assets that you know of? Esau, any current asset you know?
Land.
What? Land we have mentioned under a fixed asset, it cannot be current asset. Unless if you are dealing with the business of buying and selling land. But if you are just buying land for your business use, then it's not a current asset. Another one?
Furniture.
No, furniture we have also mentioned it's a fixed asset. Furniture and fitting. And we have said fixed asset, those are assets that we expect to serve the business for a long period of time. So can you buy a seat to serve the business for 1 week or for 1 month or for 2 months? It's not viable. You cannot keep on replacing seats. Another one?
Account receivables.
Yes, accounts receivables. So those are the people probably we have offered the service, they have not paid. Like now, if we have trained you, once we cover syllabus and you have not paid fees, you are a current asset. We know you will pay within within next month so that you are able to sit for your examination. Another one, Kennedy? Naomi?
Cash and bank.
A cash in bank is also a current asset that when we place our money in bank, we don't anticipate to hold them for a very long period of time. We probably, because we are waiting for us to have sufficient funds to buy stock, so we'll keep them for some time as we accumulate those monies. But we don't anticipate to keep them for a very long period of time. So that's also a current asset. Another one?
Stock.
Stock, very well. So stock is also current asset that when you buy stock, we anticipate that the moment we place on the shelf, customers come and buy them off so that we clear it and we make profit. So that's also a current asset. So we'll record those assets, then we can record those values here. So we'll record those values here. Then we'll add and get the total. So the total, we'll bring it in the last column. Then we'll add to the total fixed assets. Add to the total fixed assets. So when we add the value we get, we refer to it as total assets. Total assets. So we'll record them here. And we can also close that. Then we go, remember our formula was asset is equal to capital plus liability. So we want to go and look at capital plus liability. So we can start off with the current liability. Current liability. Who can mention some of the current liabilities? Any current liability you know of?
Alone.
Yes, Esau?
Alone.
Yes, I'm getting you, Esau.
Loans.
Which type of loans? Not all loans is current liability.
Shut down.
Talk of bank overdrafts.
Yeah.
Yeah, bank overdrafts, those are the current liabilities. Another one? Georgina?
Accounts payable.
Yes, accounts payable. So if at all we have people who have supplied us with the goods and you have not paid them, so that's a current liability. Or if we have people who have provided us service, employees have worked and you have not paid them, so that's accounts payable. So that's what we record under current liability. So we'll record them and record those figures as they are here. Then we'll get total. That total, we record it here. Then we'll go to financed by. Financed by. So under financed by, we look at capital plus long-term liabilities. So which are the long-term liabilities? As I had mentioned, bank loan. So if a business has a bank loan, we have debenture, we have share capital, ordinary share capital, preference share capital. We have retained profit, if at all the profit that we made from the income statement, retained profit and all that. So we'll also record these particular parameters, all of them, and then we add to get the figure here. So let me pick a different color so that I'm able to illustrate. We'll add these two figures. These two figures, we'll add them together. When we add them together, we'll get the total. So we'll record here. And close this account. Now, of concern, remember our formula was assets is equal to capital plus liability. And we have already recorded the capital and liability here. So these two values that you have added, that's the total for capital plus liability. So in that perspective, let me pick another pen. The total we get here, this total here, should be same as total here. This total we have said, total assets. So these two totals should be same for us to have achieved that particular equation. But for some reasons, they might be different. Who can give us some of the reasons why you can do how we have done, but you get a different answer? Rachel, what are some of the reasons that we could have done it very well, but it doesn't balance? Naomi, you have some of the reasons?
No, I don't.
So you believe it should balance by all means? So in interest of time, because I know you are switching to another class, I'll give you some of the reasons. That we have some errors that we can commit. We have one of the errors, we refer to it as error of omission. Error of omission means there's a transaction that actually happened, but now that transaction was not considered when you are recording our items. For example, the business had land and building, and it was not recorded. So in that case, that value for land and building will affect our balance sheet. It will not balance. And then we also have error of commission. Error of commission, it means we have introduced a transaction that was not there. And now for the exam purpose, it may not necessarily be you introducing as a student. It could be an examiner who introduced a transaction that was originally not there. For example, if at all there was opening stock and I've there was no opening stock and I've included opening stock. So in that case, that will affect our balancing of our income balance sheet. Another error is error of computation, that the way you have done the computation, we didn't do it perfectly well. So while keying the figures on calculator, somehow we made an error there. So in that case, it will affect our balance sheet not to balance. The other errors we can also make is we have talked about omission, commission, and computation. So those are the main errors. And then if we didn't, it's error of posting. If we are told we posted a transaction that was to be posted in an income statement and we are posted in a balance sheet. So again, it will affect our balancing. So because there are transactions that specifically are for income statement and there are transactions that are specifically for balance sheet. So when you interchange, then it means we will not balance. Yeah. So those are some of the errors that can make us not balance. With that much said and done, I'd like to give you an opportunity to try and do that particular question on your own. Try to apply the concept I've given you on your own. And then when we meet next week, we can compare notes. If you are told it balanced or did not balance, then we can see what else we can do. I will entertain one or two questions before we allow you to join the next class. Anyone with a question or concern? No one has a question or concern? So I can presume you are contented. So, okay, today's lesson, we have recorded part of it. So I'll send you the link for the lesson tomorrow so that you can, as you do that particular question, you can refer to it. I know Nani Kennedy said he did not have a book, so I know he has not made, and he cannot cram all this information. So for your sake, I'll circulate the link to that particular class tomorrow, probably by afternoon, so that you are able to refer as you make that particular computation. So with that much, I pray for you that God may bless you, God may give you wisdom and wit when as you pursue your course, then have some dedication, and also you'll make it. I know you'll make it. So wish you a wonderful evening as you also progress to the next class. May you be blessed. Let's meet tomorrow at 7 p.m. As tomorrow I've said we look at taxation. So let's meet at 7 p.m. doing taxation. Have a wonderful evening. Let's meet tomorrow.
You too. Thank you.
Thank you. Thank you.
You're
Thank
welcome.
you.
You're welcome.